Hi, good afternoon, everyone. It's Terry Gardner from CJ Lawrence on the 13th of June, Tuesday, coming to you from sunny Midtown Manhattan. 3 points to our call today. First, we want to take a look at product cycle versus market cycle. Secondly, we want to talk about how the game is tied. And then thirdly, take a look at the balance of 2023, looking out for the next couple of quarters and comparing GDP growth forecast versus earnings growth forecast for the S&P 500. So first off, product cycle versus market cycle. What am I talking about there? Well, first off, when you look at the broader market backdrop in terms of earnings and interest rates, it's not particularly conducive to higher stock prices. In fact, earnings forecasts have been coming down for the past several months, and interest rates have been on the rise for the past several months, and perhaps could go up further tomorrow when the Fed releases the results of their meeting, their June meeting. Perhaps they pause, who knows, maybe they go again in July, but nonetheless, the Fed funds target rate is somewhere between 5 to 5.25, could move up 25 basis points this month or next. The point being that there are about 10 names in the S&P 500 that are doing extraordinarily well. And given the backdrop for the market, it can be somewhat surprising that they're doing as well as they are. The point being that these companies that are performing are on the precipice of a new product cycle. I'm referring to artificial intelligence. And we've been talking about AI for a long time now, but it was really the release of ChatGPT that catalyzed the discussion about commercializing AI, artificial intelligence for everyone. And what that did was propel the leaders in that technology to the front of the market. So you've had names like Microsoft and Amazon and Alphabet and Meta and others doing particularly well, despite a market backdrop that would tend to hold back stock advances. So that's my point with number one, is that product cycles can often trump market cycles. And therefore, you need to be in the right names and on the cutting edge of innovation. So point number two, the game is tied. What do I mean there? Well, when I look across some valuation metrics versus bond yields, it's kind of knotted up. The Fed funds target rate is 5 to 5.25. Again, may go 5.25 to 5.50. The 3-month T-bill is 5.25, and the earnings yield on the S&P 500 for this year is 5.1. For next year is 5.6. So all kind of within 30 or 40 basis points of each other. Now you'd like to see stock yields higher than short Treasury yields, because of you want a risk-free rate, you want a premium to invest in stocks. But nonetheless, they're not completely out of whack at this point. So that's the point that I'm making with regard to the game is all tied up. We need something to break here. The bond market from the 10-year Treasury is telling you that rates will go lower. Forward estimates for stocks are that estimates could continue to come down. GDP forecasts are showing that the economy is going to slow in the back of this year if you listen to the consensus from economists that submit their estimates to products like FactSet. So something's got to break here, and we've got to get some direction in earnings and interest rates in the coming weeks. But for now, the game is tied. And then thirdly, okay, so what does that mean and what does it look like for the rest of the year? I think what's kind of interesting is that if you look at GDP forecasts for the remainder of this year, I'm talking real GDP here, so adjusted for inflation, the second quarter forecast, and again, this data is from FactSet, up 1.4%, third quarter up 1.1%, fourth quarter just barely up, almost flat, 0.3%, okay? So declining GDP quarter to quarter for the balance of this year, being forecast by economists that submit their forecast to FactSet. On the other hand, earnings expectations down 5.3 in the second quarter. So we're expecting a down quarter. I would say down 5% is pretty meaningful. And then rebounding in the third and fourth quarter, to the point where, again, economists think GDP is going to be worse in the fourth quarter. Stock analysts believe that the fourth quarter will be the best in terms of earnings growth forecasts. So a divergence there in terms of GDP forecast and earnings forecast. We'll see which one actually plays out. And the point then in wrapping up today's video is that you've got to be increasingly selective in this market. The macro is not giving you very many ideas, clues, direction as to where things are headed in the balance of this year and into next. So the message from the market is that stock picking becomes that much more important. And when you look at the leaders year to date, it's telling you that you want to be in companies that are on the precipice of a new product cycle, the innovators. And that's where we like to be invested here at CJ Lawrence. So if you have any questions about today's video or how we're investing, give me a shout, 212-888-6403, or email me, tgardner@cjlawrence.com. Look forward to hearing from you, and have a great evening.